Good morning. It is Friday, April 24th. Here is what is on the agenda. The standoff in the Strait keeps oil up for a fifth straight day. Chips continue to rip. AI boosting earnings at Intel and SAP, but costs jobs at Meta and Microsoft. And Europe grapples with the energy shock.
Talking of that energy shock then, Tom, this is the picture on oil right now, just up by 0.4%. But look at this, 105. We're moving higher and higher and higher. Many days in a row this week we have been moving higher, and that is putting downward pressure on European futures today. We're down by 0.5% here in Europe as we increasingly focus on what can be done for European economies in the face of this. The story in the States is a little bit different. Those numbers out of Intel perhaps putting some upward momentum behind tech stocks once again. Nasdaq futures up by 0.6%. The countdown to the opening trade starts right now.
Friday the 24th. Good morning. Two things have happened this week which seem odd. The first one is that oil is up, I think it's up 16% right now over the last 5 days. So that's Brent. 16% to the upside. Anna was just pointing out where we are, well north of 100 now. The other thing is that the semiconductor sector has absolutely rocketed. There's various kind of ways you can look at it. I'm going to give you the Cosby. It's up by 4.5%, nearly 5%. Are those two things incompatible, or are they compatible? Can those two things, do the Venn diagrams overlap in any shape or form? Can you have an energy crisis at the same time as you have a semiconductor surge? At some point, do they overlap? And if so, what happens when they do? And have we had an energy crisis yet? Because that's why we can keep the two Venn diagrams separate. I don't know, but it's been an incredible week.
Yeah, absolutely. Does what's going on in the Straits of Hormuz catch up with the AI boom and the chip sector? A question you've been asking some of our guests, Tom, this week. And it's a valid one because this is an energy-intensive industry. And it costs energy to produce this stuff as well.
It does. And we were looking at the strongest gains for oil in a week since the first week of the war. And at some point, there has to be an answer from the data centre build-out in terms of how they adjust to higher energy prices. But for now, the point is still there, that the semiconductors, in terms of the fully semiconductor index, up for 17 straight days, staring down that oil price. But at some point, is there convergence? It was interesting to hear from the Deputy Governor of the BOE speaking to the BBC, saying that at some point she does expect, and the BOE does expect to see a correction for global stocks, partly because of macroeconomic risks, a nod to Iran, but also partly because of AI, and partly because of some of the concerns around what could happen when those two things collide. Private equity as well. Private credit was also something that she flagged.
Is it an energy problem for the data centre build-out, or is it a cost of funding crisis? I.e., if we get could the cost of funding come down if there's a growth shock, or does it go up because there's an inflationary shock? Because that appears to be one of the critical inputs right now.
It does. And right this week, we seem to be back to worrying about the inflation side of things. If you look at what's going on with, you talked about oil prices up for a fifth day, and yields have been rising. The yields up on the 10-year in the US and the dollar, both heading for the first weekly increase in a month. So it seems as if we're back to thinking about inflation, which was the dynamic at the very beginning of this crisis. And I wonder if that's because we'd lulled ourselves into thinking, oil prices had been kind of stable between 90 and 100 for a little while, but now we are slowly breaking out of that. We're not seeing a return to the volatility of the earlier weeks, but the oil price is creeping higher, and maybe that takes its toll on inflation.
And inflation is taking a toll on gold as well, which is set for losses for this week, and are down about 11% since the start of the war. So gold is under pressure again. It had 4 straight weeks of gains. This week, though, set for losses. So is AI is delivering in terms of semiconductors. It's also delivering in terms of earnings, both on the software front and the hardware front. And interestingly, from two companies that are both facing different challenges. Intel, with an incredible beat for Intel, suggesting Lip Bhutan, who's the CEO, is starting to turn things around. But a lot of those gains coming through as a result of demand for their CPUs that go into those data centers. In the quarter that they reported from, the expectations were that they'd earn about 1 cent per share. They earned 29 cents
so the stock went a lot higher.
So the stock soared about 20% at one point. That's the Intel story. Then there's SAP, which has been challenged as part of the SaaS apocalypse as one of those legacy providers. It can be challenged on margins. But that actually came in. The backlog is looking relatively stable. The earnings were a beat. So for now, this is not a business that's crumbling. It's facing pressure. The CEO's talked about that and how this is a pivotal moment. There could be pain. But it certainly wasn't a disastrous set of results for SAP. They're holding the line, at least at this point.
Yeah. What is it, 25% cloud conversion number? That was described as disappointing a little while ago.
Yes.
I think they're quite happy with it.
But interesting, the suggestion is that the stock goes higher this morning, as if the market is focused on something else a little different this time around.
It's just for a moment, software had a terrible day yesterday. So, yes, the stock is up overnight. But it was down 6% yesterday. So I think kind of net, that's just kind of it. Software did not have a good day yesterday. And I think today's numbers need to be seen as a backdrop. To Tom's point, I think there's a sense of stability that wasn't expected that is there. But it's not a great number.
And then there's this positive story around Intel and the SAP story, perhaps, that we're going to see today. That will feed into, Intel specifically, feed into NASDAQ futures. That's the positive. Yesterday in the States, though, we did see this other narrative around tech, which is worth dwelling on for just a moment, which is the job losses coming out of Microsoft and out of Meta. And these two businesses are still recruiting people on the AI front, but in terms of what they're doing elsewhere in their labour force, Meta planning to cut 10% of their workforce, Microsoft a voluntary buyout of 7% of their US workforce. So we're talking about thousands of people here in this particular industry. Previously, when we've seen waves of this firing from tech companies, these are types of people who've been able to get jobs elsewhere. So, that was certainly the story some years ago. We'll see whether that continues.
It's a much tougher environment now.
It's such a much tougher environment. It plays into this conversation about whether, these businesses might be fine with AI, but what about the labour market? And for how long can you continue with that dynamic?
23,000 jobs potentially combined from Microsoft and Meta. It's worth noting, we should watch ASML as well at the open. We will, because of the Intel strength and TSMC as well. So there may be a read across to ASML.
Can I just point out that Intel trades on... Its PE, its forward PE, is spectacular. I think we've got it down as kind of 160 or something like that. I can't remember the exact number, but it is amazingly high in terms of the forward-looking numbers.
The energy story that we started this programme talking about is certainly something that's going to be in focus in Cyprus today. EU leaders to talk about what European governments can do to face up to this. We've got gas and Brent up by more than 30% since the start of the war, of course. We actually heard from Europe on its plans on Wednesday, the Accelerate EU plans, talking about optimising jet fuel distribution, reducing energy taxes. We've heard from Giorgia Meloni in Italy. She says this is not enough. And it does seem as if we're going to have to wait a little longer because, for example, there are plans that are going to be coming in the following months. Things like demand management plans. What do they call them? Demand reduction measures. They're not due till next month. So this might be just a bit of a holding pattern.
What I find slightly amusing about this is the EU's prepared to talk about kind of the taxation story around electricity, making it more kind of affordable, managing the kind of the overall energy picture. When it comes to demand destruction, I suspect they're going to leave it to nations. There's not going to be an overall EU plan on demand destruction. This is your problem, not our problem.
That's got somebody else's flag on it.
Yes. And they're going to be taking lessons from COVID in terms of how you restrict that demand. But Meloni pointing out as well, with the obvious, which is that different countries have different budgetary constraints and different countries have different abilities to address this and more or less fiscal room, and therefore that is like a nation-by-nation level that's going to pose a challenge.
Yeah, she would like an EU solution, I suspect.
Absolutely. And this was very expensive for some governments in 2022. And I think that's the comparison that really hangs in the air in Cyprus as they meet. Everything that governments did then, very expensive. And taking a step back, this will also be something that they'll talk about, no doubt. There are a lot of arguments that actually if you put in subsidies, yes, it cushions in the short term, but it reduces the price signal that tells you what to do in the future. Structurally, how do you want your energy market? Electrify, exactly. And that's what they want to incentivise.
Dominik Asam is the CFO of SAP. He will be joining us shortly. Obe Ejekeme Carmignac, Global Equities Fund Manager, joining us around the table as well, as will be Maria Demirtzis, European University Institute Economic Policy Professor. We'll talk about what the EU can do about the oncoming energy crisis that it now faces.
Here's what else we are watching throughout this Friday. 9 a.m. UK time, Germany, IFO Business Climate Survey. We'll break that for you, of course, and bring you analysis. 9 a.m. UK time. The SMB's Schlegel will be speaking at an AGM in Bern. We'll mark that. 3 p.m. UK time, it's the University of Michigan Consumer Sentiment Survey. So we're touch there on the US consumer, and later on the earnings front, Procter & Gamble, Baker Hughes in the energy side of things, and Carnival on the tourism and leisure sector.
What else do you need to know this Friday morning? President Trump says he's considering having the US government purchase bankrupt carrier Spirit Airlines. Sources say the deal would involve a financing package of up to $550 million in exchange for warrants that would give the government the right to purchase up to 90% of Spirit after it emerges from bankruptcy. Trump has a special kind of relationship with the airline sector. Deepseek has rolled out preview versions of its new flagship AI model, calling it's the most powerful open source platform in a challenge to rivals from OpenAI and Anthropic, which of course are closed. The Chinese startup unveiled the V4 Flash and V4 Pro series, touting top-tier coding performance and big advances in reasoning and agentic tasks. The firm, however, is warning that the rollout will initially be constrained by the availability of computing power. Heard that one before. And the Justice Department in the United States says a US Special Forces soldier has been charged with using classified information to make more than $400,000 trading on Polymarket. Prosecutors say the soldier was involved in the planning of the capture of Venezuela's Nicolas Maduro and used that knowledge to place bets on his removal. The case is raising concerns that the fast-growing prediction market may be vulnerable to insider trading. Polymarket says insider trading has no place on its platform. Van Dijk has not publicly responded to the allegations.
Coming up on the programme, Estonia's Prime Minister calls for Ukraine's full EU membership as leaders gather in Cyprus. We will bring you some of that interview later in the show. Plus, we will look at your stocks to watch, including the truck maker Volvo, the company reporting a profit beat thanks to order growth in the US and in Europe. Up next, we will be joined by Aliki Rufiak, multi-asset portfolio manager at Rebecco. Please get involved in our conversations. IB plus BBTV Go. That is the function to get in touch with the team. This is Bloomberg.
How long are you willing to wait until you get a unified response?
Don't rush me, Jeff. Guys like you want to say, so we were in Vietnam for 18 years. We were in Iraq for many, many years. We're in for I don't like to say World War II because that was a biggie, but we were 4.5, almost 5 years in World War II. We were in the Korean War for 7 years. I've been doing this for 6 weeks.
President Trump there responding to a Bloomberg News question about how long he's willing to wait for a response from Iran. That's as both sides maintain their blockade in the Strait of Hormuz and tensions grow. President Trump has ordered the US Navy to, quote, shoot and kill mine-laying vessels, raising concerns that peace talks have stalled. For more, let's bring in Bloomberg's Jumana Basechi, who's in Dubai. Jumana, then, good morning. With the naval blockade still in place, what are you seeing? What's the latest news lines coming out of the region?
Yeah, well, very little signs of a breakthrough. And we just heard comments there from President Trump suggesting that he's not in a rush, drawing perhaps what some would describe as an uncomfortable parallel between the current situation and previous wars that the U.S. have engaged in, including the Vietnam War and Iraq War. So, he's suggesting that we are in the early innings of what could be a prolonged conflict. At the same time, the Iranian side asserting once again that they're not going to go back to the negotiations table until the U.S. naval blockade is actually lifted. No signs that the U.S. have plans to do so. And overnight, I also want to draw your attention to an article that our Bloomberg colleagues put up, also suggesting that the way that President Trump has been conducting this, a lot of the threats and assertions, the language that he's been using on social media has also not been resonating well with Iranian officials. And they say that that is actually one of the limiting factors that is stopping the two sides from getting together at the negotiating table once again. Now, at the same time, when it comes to the Strait, it's still in a situation where things are very dangerous. I mean, a couple of days ago, Iran seized a couple of vessels. They literally shot at vessels. We know that now the president has instructed the U.S. Navy to fire on any boats from the Iranian side that are seen to be laying down mines. And basically what this has meant is there are very few ships or vessels that are managing to transit through. So, this is an impasse. It's an impasse between Iran, between U.S. It's not sustainable, not just because of those two, but because of the rest of the world and the ramifications it's going to have on the rest of the world. So somehow this deadlock needs to be broken. The question is how? Is it via diplomacy? Or is it via an escalation of hostilities once again? I will just draw your attention as well to comments from the Israeli Defense Minister, Israel Katz, yesterday. And he said that they are ready to go once again. They're just waiting for the green light from the U.S. to, quote unquote, finish the Khamenei regime once and for all.
This time last week, Trump was saying it was all over. Peace in our time. Didn't happen. Obviously, 1 week on, we're in a very different situation. Jumana, thank you very much indeed. Jumana Basetchi joining us from Dubai with the latest. What a week it's been. Oil prices are up circa 16%. That's Brent. The semiconductor sector is up significantly. Yields have risen, which also I think is interesting in terms of the tell coming out of the bond market. The bond market sees things quite differently. Liki Rufiak, portfolio manager at Rebecca, joining us around the table. Good morning.
Morning.
Does the market make sense to you right now? Semiconductor stocks shooting to the moon. Amazing performances coming out of the tech sector. Oil prices are up really sharply on the week. We're up 16%. What do I look at? Which signals do I take as being real and not real? Is it just a duration story in terms of the semi stories now and the oil story is further down the road and hasn't arrived? How are you looking at this market?
We see, first of all, increased tail risks within our base case scenario, and this emanates from the prolonged closure of the Strait of Hormuz and higher energy prices. So since the end of February, we have seen the Brent oil price going up by 45%. And typically, what we see during supply-side shocks, oil shocks, is that the price of oil remains elevated, so approximately 20 to 30% above pre-conflict levels for the next 12 months.
OK, so what is your base case? And is that, are the tails getting closer to the middle of the distribution of outcomes?
So going back to what that means, I think, for the inflation trajectory, what that means is that we are likely to see oil price around 80 to 90 US dollars over the coming months. And based on this assumption, which is our base case assumption, we are expecting inflation rates for developed markets to move higher, closer to the 4% mark, and potentially exceed that. However, whilst these levels are higher than the 2% central bank inflation target levels over the medium term, we do expect that these levels are likely more informative for headline inflation. What we have also seen is that the pass-through from headline inflation towards core inflation prices during this type of scenarios tends to be very low and very limited.
So I can look through it.
So with that in mind, I think central banks can afford to look through it and not raise interest rates in the short term.
Transitory? Do we use the word transitory?
Yeah, maybe we do. I mean, yes, good morning, Aliki. Yes, the danger we know with saying it's transitory and we look through it is what happened in 2022. But some people draw a distinction between the inflationary backdrop in 2022 and what we're seeing now and saying, you know, then it was, or at the beginning of this decade broadly, then inflation dynamics meant that inflation was going to spread through the economy more than it will this time around. Is that what you're seeing? I mean, I was looking at some of the retail sales data out of the UK today and some of the sort of high-frequency data out of the US and wondering, whether the consumer is buckling a little in the face of what they're seeing right now.
So the main point to mention is also what we should be expecting from central banks. We have a very heavy central bank week next week with ECB, Bank of England, and also the Fed. And what the markets are pricing currently is rates are on hold. The other very important driving factor in terms of going forward is how markets are going to differentiate between the regions, countries that they would likely be more heavily impacted by the energy crisis, like UK and Europe, which where we see rate hikes actually priced in over the next 12 months relative to what's happening in the UK. And with that in mind, I think if we also see a positive scenario in terms of the reopening of the Strait of Hormuz and some easing in the energy prices, then the shift would be mostly on the second round effects of inflation. And there we see two catalysts. On the first side, we see that excess capacity in Eurozone and China is likely to keep a lead of secondary effects on inflation in the short term. And in the US, there the situation is more what's going to happen in the labor market. So a likely easing rather than tightening, which was the case back in 2022, is likely going to, we are likely going to experience a lower impact of wage growth this time round, hence second round effects of inflation are relatively more muted in
So the inflation backdrop is different to a few years ago, but the labour market backdrop is also crucially different. So you think then, if you're right then, Aliki, how quickly does the market unwind its expectations for rate hikes?
I would say relatively quickly. We've seen that at the end of last week, where we had more positive news flow. On Friday, markets have been very strong on the day, but also the interest rate expectation over the next 12 months has been priced out. So the changes that we're likely to see, if a scenario like that again materializes, are going to be very swift.
OK, different regions will be impacted differently by the inflation. You talked about UK, and you're looking at 4% maybe for some nations in terms of the inflation impact. But you are actually leaning into the front end. So you quite like the front end, Germany, UK. Explain the rationale behind that and what the opportunity is there and how long that opportunity remains open.
So one of the areas where we haven't seen a full retracement across that asset space is fixed income. They are particularly on the front end of the curve. We see rates higher between 60 and 80 basis points for the UK and Euroland. And we find this as a very attractive opportunity at current levels, given that we believe that inflation is going to be transitory. And again, under a more bearish scenario, a growth shock would imply that central banks could also cut interest rates if we move towards a more recessionary type of scenario priced in the markets. OK,
that's the inflation story. What about the chips and AI story? Where do you want to be sitting in terms of the run-up that we've seen, particularly in semiconductors? Are you comfortable with those gains? Do they make sense? Do they have further to run?
What we've seen is US hitting all-time highs again in the markets. And in terms of our equity positioning, we are very selective there because the leadership in the market has changed. So tech has rallied quite strongly. And I think this has come at the back of two catalysts. The first one is very positive earnings growth expectations for the space, but very weak positioning as well. So for us, we like the AI story, but we're very selective in terms of how we approach that.
What does that selectivity mean?
We prefer to implement this through option strategies, so call spreads in the US, now that the volatility has also switched a little bit lower.
Aliki, thank you very much. Aliki Rufiak, Portfolio Manager at Rebecca. Good time to point out, as we're thinking about inflation, what this does to the European economies, that we've got European leaders, of course, meeting in Nicosia, in Cyprus, and we've got live pictures of that coming through. The European leaders are just arriving. And we've heard from the Spanish Prime Minister Sanchez, who's saying that they need to seek more ambition from the EU Commission on energy. He's in favour of a windfall tax on energy companies. We'll see how that is met by others. They also want an extension of EU funding for energy transition, and they need to talk about fiscal rule flexibility for energy, which is something I know that has been part of the Italian conversation as well.
That all seems fairly straightforward. That's the easy bit. If there's demand destruction required, how does that work?
How do they factor that in?
Yeah.
Interesting reporting from Bloomberg in terms of the barrels of oil coming now from the US to Europe. They've put about 79 billion barrels of oil from their strategic reserves onto global markets, and some of that is making its way to Europe right now. And we hear from the likes of Shell that their refineries now are at max capacity for jet fuel. It's just a reminder of the tightness there. A bit of flow coming from the US is not going to offset.
Apparently, we know it comes from their strategic petroleum reserve because of the name it's given.
Yes.
It's named after the cave that they keep it in.
And sometimes there's a concern about quality because it's been kept in there for so long.
And you can't take that much out of the cave because of the geology doesn't allow you, so there's all kinds of. It's a genuinely fascinating read. Anyway, what's next?
We're going to switch focus to what is happening on the earnings front. We've been talking about tech, we've been talking about AI. We're going to get a take on software with the SAP CFO. They came through with a beat. Stay with us for that conversation. This is Bloomberg.
Friday morning, good morning. 30 minutes to go until the start of equity trading here in Europe. One thing really stands out today. By and large, futures are negative, OK? So let's call it 0.5% to 1% across most of Europe, with the exception of Germany, which looks like it's going to be lifted by tech, SAP. We'll talk about that in just a moment. And it's a similar story over in the United States. So NASDAQ futures are up by 0.5%. Intel is probably the trade there, plus a few others. S&P mini futures are absolutely flat. So you're getting a discernible difference today, depending on how much tech exposure that particular index has in terms of its expected performance.
So that's the equity story. Let's have a look at where we are on bond markets. Not seeing as much bond market action here in Europe as we're seeing more in Europe than we've seen on Treasuries. Treasuries looking fairly relaxed right now, not a huge amount of movement, but the direction of travel has been higher yields over the past week. And in fact, the bond market's heading for the first week of increased yields in a month. This is on Treasuries, on the 10-year in particular. Here in Europe, we do see some movement higher on those yields. So 3-4 basis points seems to be the extent of it, though.
OK, let's get more details on the tech story then and zero in on SAP, reporting stronger than expected revenue growth in its cloud division, beating analyst estimates. The results come as Europe's largest software company ramps up the integration of artificial intelligence agents across its platforms. Shares are called higher this morning after a brutal 12 months, it should be said, for SAP stock. But again, today called higher. SAP CFO Dominik Asam joins us now. Dominik, good morning. Thank you for your time. Analysts, in terms of their reaction to the earnings, seem pretty optimistic, particularly about the cloud story and the backlog of orders. What is your level of conviction that demand, that the momentum that you're seeing in cloud right now continues in the quarters ahead this year?
Q1 gave us a lot of confidence on that because it has been a very solid start into the year, enabling us to confirm the outlook we have provided for 2026. We increased on constant currency terms cloud revenues by 27%. We increased our non-IFRS operating profit by 24%. If you then compare that to the ranges we've guided for the outlook, you see that this is actually above these ranges, giving us, so to speak, a head start, despite what I would consider a quite adverse environment, given what we've seen in the Gulf region.
In the Gulf region, have you seen big orders being put on ice? Has that been more challenging? Have you had to scale back the ability to ship product into the Middle East? Have customers turned cold in that region as a result of the geopolitics?
Obviously, those customers, governments, but also commercial customers that have been most directly impacted by the war in the region have been distracted by what I would call a lot of firefighting around the situation and have been pushing some projects to the right. But I'd say on a global basis, it's still very solid. And that's, of course, the big question. How long will this last? How long will the Strait of Hormuz be shut down to avoid a contagion of the global economy?
Yeah, something we're watching very carefully, Dominik. Good morning to you. Away from, well, more broadly, thinking about the pricing of your products and where you're moving to on that particular story. You're moving from a usage-based pricing model, from a subscription-based pricing model, and there's going to be a hit to margins, we understand. That's the expectation amongst analysts. What kind of timing and margin hit can you describe coming from that move?
Well, the consumption-based pricing that we have alluded to is really something that will be layered in over time in a very gradual way as AI agents will consume tokens. And that is not something that is happening from one day to the next. So it's nothing comparable to what we had when we transitioned from on-prem to the cloud, where we had to defer all the revenues to the right, where there's some cannibalization of the legacy business, so to speak. Here, AI is an opportunity coming on top, which will be then more consumption-based over time. So this is a much more gradual shift, and it's actually an expansion opportunity for us, and should also bode well for earnings growth.
OK, so, I mean, your CEO said recently that there would be short-term pain. Trying to understand how painful. You're not painting a picture of much pain there.
Well, the pain we've referred to is what you alluded to in your introductory comments, which is this kind of alleged SaaS apocalypse narrative, which has been around for the summer of last year and has, of course, left its traces in the share price. So Christian was really referring to the pressure on the share price here, as opposed to anything related to our outlook.
Why is it alleged? The market is deeply concerned around this. You're saying the market is wrong. What is the market getting wrong here?
Well, I think you cannot generalize that. I just talk about what we can see in our figures. And as I said, we had a very strong into 2026. We can confirm our outlook. So that doesn't kind of confirm an apocalypse-like meltdown that people are speculating about.
OK. Do you think 25% conversion rate onto the cloud is good enough. It wasn't that long ago you thought this number was, quote, disappointing. Do you think actually you are seeing some effect, but yes, you're confirming what was a fairly cautious guidance? Do you think that these numbers are good enough? Do you think that 25% conversion rate is good enough? And do you think, to Anna's point, that as you convert from subscription to a usage model, that you're just going to become more volatile as a business to own?
Well, first of all, let me just get this straight. We have by now more than 50% of our revenues in the cloud. So the conversion of on-prem customers to cloud is much more advanced to that. I'm not sure that is what you refer to, but that is really still in full swing. And the other thing I can say is just most recently, outside third-party prominent research institutes like IDC and Gartner have confirmed extremely high market share gains of SAP in the SaaS market. So I think we have a very special situation here at SAP because the type of processes, complex end-to-end processes we are dealing with, which are around monetary transactions, where the assurance levels are extremely high, and you have to provide that trust wrapper really to make sure that people can transact with confidence. It's a different game from a more content-driven, language-driven, or even vibe coding-driven environment. So I think that's where the kind of market share gains can be explained, and the continued strong momentum of SAP, despite the backdrop of AI revolutionizing basically everything. To the contrary, we want to be on the kind of side of leveraging that technology in our portfolio to harvest either higher hanging fruit, like the very complicated processes I've just alluded to.
Dominik, is Anthropic now your biggest competitor?
I think it's fair to say that they want to go where we are already. We are just right in these complex processes. Right now, of course, the lion's share of the ARR stories that you hear out there are still around large language models in a more traditional sense, doing chats with customers, services, coding, which is also some type of language. What we talk about is really the ultimate decision point of a transaction, triggering a monetary transaction that has consequences. You have to be first time right, very different assurance requirements. And there we are. That's our kind of core business. And of course, they want to go there. But rest assured, we want to lead that market as opposed to being a follower there.
Can I ask you another question, Dominik, about the pricing model then? Will there be options for people, for customers to stay on the status quo? If they don't want to move to a usage-based model, if they like the predictability of a subscription, can they stay there? Because even your CEO, I think, has acknowledged that it's quite difficult for some businesses to predict what a usage model will mean to their costs.
Yeah, it's indeed a big challenge for our customers. Many CIOs would love to have predictability. By the way, we have the same situation right now that consumption of tokens for coding goes through the roof as the adoption of these new AI tools also by our developers is really making great progress. It's becoming more expensive. But on the other side, you also have a great value added, a great productivity gain. So I think those vendors who have the leverage to give a differentiated offering to the customer that provides productivity will have some leverage in deciding what type of monetization model we give.
Okay, just to kind of stay with this theme, one of the reasons why private equity, private credit liked the software environment was that it did have predictable revenue. It was based on a subscription story. That was one of the big attractions of it. Do you think if you do move to a pay-per-use model, that your business will become more volatile? Or do you expect that actually there will be the same volatility or less volatility? What do you think happens in terms of your revenue volatility if you do move to this model?
Yeah. I mean, again, as I said already, that kind of consumption-based model is like an increment coming on top. So we have a very strong subscription-based. By the way, today already we have some consumption-based models like on the BTP. We have this BTP EA enterprise agreement credits where people for development are consuming credits. We have tools like Travel in Concur where people are paying per transaction. So it's not a new model. We have the metering in place for all that. It's now really more about the value creation with AI. We want to come from a cost-plus type of logic to participating in the value that our tools can deliver to the customer. And that's the strategy of many of our peers. But indeed is that dilemma that we have to manage the predictability on the one side for the customer and also for our cost base. I mean, if you spin these GPUs, it's not necessarily for free. Yeah? So also API calls on our infrastructure will be charged because we have some effort for that. We have some cost for that.
Yeah, so there's a cost there. There's a cost in the R&D that goes into building these AI products as well. Dominik, does that mean you're going to have to trim headcount at some point?
Well, it's clear that we have an extremely dynamic environment in the tech industry, and the domain you point to, which is the development, is the one where the productivity gains have been most tangible, most impressive in the most recent past. And we will leverage to the full extent these new technologies. We have a lot of customers really pointing to certain feature gaps. We have been quite selective in the past about how many customers we need before we start developing solutions. I think with these new tools, we can really pull in the roadmap of deliverables from SAP, make sure that the customer needs are satisfied in a very speedy manner so that they don't need to do it themselves. And we still benefit from the economies of scale that we're not developing for one customer only, one company, but for myriads of customers. So that model is unbroken from our point of view. And the question what that exactly means for headcount is really hard to judge, because then we would look in the crystal ball and say what exactly will be there in terms of productivity gains. There are ranges out there, but for the time being, I would say let's really speed up, drive the top line, and make sure we are a strong winner in the AI race.
SAP CFO Dominik Asam, thank you for your time on the back of that earnings beat with the stock called higher this morning for that software giant. Staying with tech, as we mentioned, Anthropic's Mythos AI model has been the talk of the industry in recent weeks. The company says the tool is effectively too powerful to be released to the general public, but the headlines may benefit Anthropic as it sees potential valuations approaching $800 billion US. The company is the subject of this week's Bloomberg Originals Weekly Doc.
If you look at the AI sector landscape more broadly, what you've seen is OpenAI's early dominance being challenged increasingly by Anthropic.
Anthropic is drawing investor interest at a valuation of $800 billion or higher,
making it close to, if not the most valuable startup in the world.
Turbocharging the hype is Anthropic's latest model called Mythos.
Only a small number of companies outside of Anthropic have access to it, and on a limited basis.
This limited release has been dubbed Project Glasswing, and all the participants include a who's who of Silicon Valley.
We know that Apple, Google, Palo Alto Networks, CrowdStrike, the Linux Foundation, Amazon, that are part of this Glasswing project. It's a highly unusual arrangement. These are fierce competitors who are trying to get the best model out there. And Anthropic is not only showing them sort of some IP that hasn't been released yet, they're allowing their competitors to potentially criticize some of the work that they did.
The unorthodox rollout has generated a lot of publicity, and already there are reports of unauthorized users accessing the model.
This is terribly basic cybersecurity practice 101 that was missed here.
We have been hearing about this theoretical threat that AI poses to cybersecurity, and what Mythos has proven is that that threat is a reality.
There are big worries that this, if it falls into the wrong hands, it could essentially lead to some of the greatest cyber risks that humanity's ever faced.
With massive potential for havoc and the stakes so high, is tech's era of move fast and break things finally over?
And you can watch the full Bloomberg Originals documentary on the terminal at Bloomberg.com and on YouTube. There's a lot more coming up. Stay with us. This is Bloomberg.
Risk premium in equity markets and credit markets are at a 20-year low, which is an astonishing fact. So what the market is effectively saying is this is the least risky macro environment that you've seen for the last 20 years. Markets are saying there's a 90% probability that this will not lead to weaker growth momentum. And we have to judge, is this a correct assessment of where we stand?
In Europe, you're probably going to see a few percent earnings growth, also quite skewed banks and energy are probably going to give you a lot of that growth, whereas other companies, it's flat or even slightly down.
As a company, and to a certain part probably as an industry, we're less impacted by the conflict in the Middle East. The one reason is that we are very energy efficient.
From the Middle East conflict, of course, there has been a huge demand now on sensor capability to detect sort of incoming missiles and drones.
If you look outside of tech and energy, the rest of the sector, yes, we haven't seen upgrades, but we haven't seen downgrade neither.
We're not seeing at this point an impact on demand. If we see this conflict continuing for much longer and we stay in a world of higher inflation, then over time that does have an impact. But at this point, we're not seeing a whole lot of pre-buying, for example, in Q1.
It's far too optimistic. I think there will be demand destruction, and I'm positioned for risk premium to go wider. Risk premium at a 20-year low at the current juncture with all the risks we're facing is the wrong probability distribution. Maybe there is a good case outcome, but it's not a 90%.
Investors and CEOs giving us their takes on the impact of the Iran war on their earnings or the earnings of companies they invest in. Let's turn to today's markets in 3 minutes on the opening trade with Paul Dobson, Bloomberg's executive editor for Asia markets. Paul, here in Europe, it seems like the only thing you need to know is that oil prices have been going up all this week, and we're just flirting with $106 a barrel as I look at Brent. And that seems to be what matters to European stocks. Meanwhile, the Nasdaq is focused much more on Intel and that particular story. How are you looking at this particular divergence right now?
Yeah, divergence is the word, I think, Anna. Good morning. So the market is really sort of grappling with these two different things that are going on, right? On the one hand, we have the AI boom still getting priced in or repriced in. And so we're seeing that continuing acceleration of US tech-heavy equities and, for that matter, North Asian stocks as well. But each day this week, each day that this conflict goes on, we're seeing those oil prices steadily increase. And this has been the biggest percent increase since that first week of the war as well. And that tells you that we're really seeing sort of stasis, no signs of a shift in the talks between US and Iran, at least in the public sphere. And the market is starting to get more and more worried about that because we know, and we've been saying it for 8 weeks now, that the longer that this goes on, the tighter the energy supplies get and the more that there's going to be an impact on the economy over time, starting probably in Asia and then spreading west.
Do we resolve the problem of kind of how this market is working? Oil prices up on one hand, but the semi-sector up on the other hand. Does it get resolved by looking at who is buying? It's interesting, the markets team here forwarding me a note that came out of Goldman Sachs talking about the fact that pension funds have actually been selling, but it's the CTAs and to a certain extent re-risking of hedge funds that have been basically chasing this market. Is it that kind of internal flow that tells you about what is happening here? That actually, big picture, institutions are very nervous about this kind of environment, but the CTAs, the momentum chasers, have had to get on board and basically chase this tech story as hard as they have been.
Yeah, and if that's the case, then that sets us up for a rather shaky times, right? Because those are the sort of flightier, faster money investors that are just as likely to get out again as they are to hang on in there. So unless you get a capitulation where you have more of the long-term investors folding into that because of fear of missing out and because of their underperformance relative to the gauge, then at some point the market will potentially run out of momentum, and that could be a dangerous point. Or we get to, a moment where we have a bit of a volatility shock again, some sort of a flare-up, and that turns us around even more critically. What I do think is that some longer-term investors are taking a view as well, because you're seeing that show up, in the relative stability in the bond space and in the currency space, where people are moving back into the carry trade. So because there's lower volatility, people are thinking, all right, target this right, short yen, where interest rates aren't going anywhere particularly fast. Have a look at higher yielding emerging markets, energy producers, places like that where you can put some money and still continue to pick up yield. And that seems to be a safe investment, again, with that proviso that it could all go wrong if we do have another flare up in the Middle East.
Bloomberg's executive editor for Asia Markets, Paul Dobson. Paul, thank you. Let's get your stocks to watch now, or at least stocks that could be on the move this Friday, and bring in Chloe Melly. Chloe.
Good morning, Tom. SAP is in focus today after beating analyst estimates. So this could help lift the shares after what has been a very steady downward trajectory for that company, and could also really help reassure investors in that software sector generally, with analysts saying that this eases some fears around AI disruption. We all remember, of course, the big software sell-off from earlier in the year, but also help ease fears around the impact of the Iran war on business confidence. So we should watch out for SAP this morning. Moving on to another company that could be moving higher, and that is Siemens Energy, which raised its outlook last night. It's one of those companies that has been a really big beneficiary of this growing energy infrastructure demand from data center customers and grid customers as well. And so we could see that raising again that share price, and analysts are saying that this shows that this really this investment cycle is only really accelerating, is not peaking just yet. And so we could see even more movement there for Siemens Energy. And finally, Volvo is also in focus after raising its outlook for the European truck market. They show some early signs of recovery in that truck market after what has been quite a prolonged slump in demand. And so we could see both Volvo but also its closest rival Daimler Truck go a little bit higher on the back of that this morning.
Chloe, thank you very much. Chloe Melly with some of the stocks in focus. I'll add into the mix Electrolux. They're talking in quite dark terms about what's happening to the US consumer, so we'll watch that one. Accor also had some guidance out last night. Revenue seeming to miss estimates. Room demand, though, holding firm outside the Middle East, so we'll watch that one. That can move a bit on some of its
the hotels
numbers.
group, travel and leisure in the Middle East, and to what extent that's been impacted. And Electrolux, the white goods trade as well.
Yeah. Do you have to fill up your card? Do you not buy a new washing machine?
Yes.
These are important trades.
And you'd certainly, maybe you don't buy a house. And it's linked to that, obviously, often. Let us tell you that the opening trade, of course, is coming up next. Futures pointing lower here in Europe. More positive picture from tech in the States. This is Bloomberg.
Welcome back. A couple of minutes to go until the start of cash equity trading here in Europe this Friday morning. Yesterday's session in the States dominated by the earnings picture, but there was also significant selling in the software sector, which is significant when you think about where SAP is going to go today. We probably finished a bit below where Europe went out at the end of the day, but there was a lot of action after hours. Names like Intel, front and centre, and they will have a significant effect, those names, on today's session, Tom.
Yeah, the hardware story, the software story, both coming into play with SAP and Intel. Beats for both of those. European stocks yesterday essentially ending the session flat. Today pointing low by 0.6%. To the SAP story, though, the DAX is unchanged, so that's going to be supportive. It seems it's called higher SAP, of course, on the back of those earnings. FTSE 100 futures pointing to losses of 82 points, down 0.8%, despite the fact that oil is higher. Not significantly so, but of course through the week, holding above that 105 level on Brent. So that is the picture, of course, on the broad index level. Anna, what are you looking at in terms of individual stocks?
Yeah, let's look at a few individual names that could be on the move then this morning, Tom. We talked about SAP quite a bit. You've mentioned the strength coming through in the numbers, reassurance maybe I should say, coming through in the numbers. And of course this was a stock and a sector that was really beaten up, as Guy was saying yesterday, so we look for a bit of a rebound there. Siemens Energy also in focus, price targets being raised for this one, I see from Bank of America, others maybe also upgrading it. Siemens Energy raising its outlook on strong AI driven demand, so that's certainly one that we will put into the mix and one that we will watch. Watch also for Volvo. This is trucks, not cars, raising its outlook for the European truck market after orders increased, and that's often quite a bullish sign for the business cycle. But business activity also improving in the Americas, they're talking about in the release today. So we'll watch all of those three then, Guy.
Absolutely, we'll keep an eye on all of those stories. Let's try and price it all in and see what we're seeing with these markets this Friday morning. Here we go. It is time for the opening trade. We're expecting the DAX to outperform. SAP is expected to have a solid day after a very disappointing day yesterday. The two-day chart on SAP, I think, will probably be quite instructive today. So the FTSE flat at the get-go of trade this morning. We have seen oil prices creeping higher throughout the week. That has been a tailwind for this sector. In fact, basic resources generally have been as well for this market. Stock 600 down by around 0.3%. These are not big moves. Below the surface, more interesting things are happening. But at a headline level, we're down a little bit. We're down 0.5% now on the FTSE 100. In aggregate this week, though, it hasn't been a great week for the European equity picture. You are potentially seeing Europe being much more exposed than the United States. The US market, more tech exposed, has had a better week. The CAC is now down by 0.7%. The AEX I've got a funny feeling that ASML goes ex-dividend today. Just bear that in mind when you look at what you're seeing in terms of the numbers. IBEX down by 0.8%. So a fairly soft session, actually, pretty much in line with what the futures were telling us. The FTSE's down by around 0.5%. Other markets are down more. I am waiting for the DAX to arrive. Tom.
Just one sector in positive territory so far. Energy up 0.6% with Brent above $106 a barrel right now. So that is the only sector across the European space that is posting gains so far in the session, up 0.6. The biggest losses coming through for basic resources. You've seen a drop in prices for silver and gold. That is weighing on that sector. Then down 1.7% on basic resources. Banks also under pressure. There was some selling that came through for financial services banks yesterday as well. Banks currently down as a sector, down 1%. Autos down 1% as well. It's basic resources, banks, autos in terms of the biggest losses. Again, every single sector in negative territory, bar one, which is energy, up just 0.6%. And we're still waiting, it seems, for pricing on SAP, Anna.
Yeah, absolutely. Waiting for pricing on SAP, waiting for pricing on Siemens Energy. And I noticed that Electrolux is halted, so there must be some big move anticipated there. So the only one we've got a price for, of the ones we were watching this morning, is Volvo Trucks, and that is up by 2.4%. So quite a positive story coming out there. And SAP rebounding a little. We bear in mind, Guy, the need for a two-day chart on this, but it's up by 4.6% this morning.
Yeah, it was down by 6.1% yesterday. So let's just have a quick look at the GIP2, just to give you a kind of two-day basis story, just to kind of figure this one out. So it is still down on a two-day basis by 1.8% at this point, despite the significant rally that we are seeing in today's session.
OK, let's get another voice on these markets and bring into the conversation Obi Ejikemi, who is Global Equities Fund Manager over at Carmignac. Really nice to see you, Obi. Thank you very much for coming in. Are we getting very different signals from different markets? If we focus in on what equities are telling us, are they telling us something fundamental about the prospects for AI? Or is there a huge positioning story we need to know about that explains some of the enthusiasm in April? What's your focus?
I guess my focus, and good morning, my focus is really on the underlying fundamentals of equities, which is typically driven by earnings. And what we're feeling as fund managers and investors is there's a lot of sentiment-driven moves. So to the downside in March was pretty horrific, but we've also seen a significant rebound. But under the surface, when we just look at the earnings of the companies that we invest in, actually very little has changed. So this is mostly sentiment, fear about the macro, fear about the risks that we can see from the geopolitical side. So that's one of the biggest drivers. Now, the impact is clearly seen in different places. So Europe has taken a bit of the brunt of this. The recovery of the market's not been as strong as, let's say, the US. But I think most of what we're seeing at the moment is more sentiment-driven.
Yes, and let me ask you about where that sentiment is having an impact. Cyclicals have been doing really well. This is in Europe, even though the City Surprise Index has been deteriorating. And you gave us this chart in your notes ahead of our conversation, Obi, which we've got a version of, that shows that. I mean, does something have to snap there between those two?
Yeah, and I think that is something that we're quite conscious of, especially when you have the sort of sentiment-driven rallies that we've seen off the end of March lows. Is there are risks that are slowly but surely building. Now, we know we started the year with a decent macro setup, but there clearly are some uncertainties. And if you get this big disconnect between what the market's doing and what the underlying potential macro risks are, then I think the chance of seeing an equity market unwind, or at least a reversal of some of those riskier trades is quite high.
The macro risks, top of mind for you, is it inflation or is it growth or is it a combination of the two?
I think it's everything that's related to one of the biggest parts of the economy that's not really been talked about as much these days, which is the consumer. I mean, everything that's hitting, that's going to be hit by this really is the consumer. And so that's where I see some of the macro risks. And we talked about some of the sectors that are in the negative territory already this morning, things like autos and any of those sectors. I think that's where you're going to see some of the surprises, maybe to the downside, because higher inflation, higher costs are clearly going to hit consumer spending.
Do you think earnings expectations for those consumer-linked companies and corporates are looking overly bullish at this point? Do you expect downgrades?
Well, it's hard to say how it's going to play out, but I think at the moment what we're seeing is everybody's quite happy with the current situation. The numbers that are coming through are probably okay. But I think what's going to happen is we'll start to see the real economy impact of higher oil prices. We saw even in the UK with retail sales jumping up this morning, partly because people are spending more money on filling up their cars. Well, that's got to be taken from somewhere else. I think the longer-term impact of this is going to be...
Dishwashers appears to be the place where it's being taken from at the moment, as far as I can tell on the screen at the moment. Electrolux is down by 20%. to that consumer story that Anna's been flagging this morning. You miss, you get punished right now. So just to kind of to synthesize this into a kind of single piece of advice, you think you sell equity markets right now? At a headline index level, you think they're overvalued and now is the time maybe to get out?
I would be a little bit more careful. I think that the one advantage of equity markets is they're not all linked to one theme. And so some of the areas...
Which ones would you sell?
Well, I think some of the areas are quite interesting, which are, especially on the technology side, which got heavily punished. And we saw a similar thing last year, right? So they got heavily punished on the fears of tariffs last year. They got heavily punished on the fears of geopolitics this year. But actually, their earnings are quite resilient. And I think the market will reward those stocks, especially...
Hasn't it already rewarded those stocks?
Well, let's see what the earnings continue to do. And I think if the momentum continues to be there, which I think will be the case,
so
because they're not...
You would chase tech and fade the consumer?
Yeah, it's a relative story trade there at the very, very least.
So which markets am I buying and selling?
Well, naturally, I think that pushes you back to the US stock market, which for at least a few months has been somewhat forgotten, I would say. It pushes you back to the US, back to technology stocks as the longer-term structural winners. I think that story is still strong.
And you say you like companies, obviously, that have strong balance sheets and have pricing power. Any reason for concern on that front when it comes to those big tech companies that are spending a huge amount on AI? Well, we've seen these headlines overnight about, or yesterday rather, Meta and Microsoft cutting jobs because of the amount of capex they're doing, the amount of spending they're doing. That doesn't mean they're necessarily worried about their balance sheets, but they're having to be careful about the spending, maybe.
Yeah, I think they're on a different side of the boat to some of the risks that I would be focused on. I think the job cut story is obviously is a big challenge. I think we're going to see that across the economy in many different places as a result of this sort of AI theme and AI disruption, which is not just a quarterly story. This is going to go on for many, many quarters. But I think their earnings and their visibility of earnings are going to be far more stronger, and that's going to be the reward that we'll see from the market. Remember, these stocks have been derated in this contraction that we saw in March, so they're a lot cheaper today than they were at least 2 or 3 months ago.
We were wrestling with the question at the top of the show about when the energy constraint starts to pose an impact on the build-out of AI, whether it does. Do you have a view on that? Do you have a model that shows you when that starts to become an issue for the build-out of data centres that could constrain some of the uplifts in AI that we're seeing?
Look, I think I don't have the specific numbers on it, but I think that it's going to be an issue for everybody. But energy constraints and energy costs have been an issue for many companies, especially even in the industrial space for some time. So I don't think it's a specifically new story. I think the demand for some of this AI will be so big and so far ahead of that I think that the revenue story will be fine for some of those companies.
If I want a place to hide out, is tech the place to hide out? Is it a safe trade? If I'm nervous about what's happening around the world, is that the place to go? Or are there other trades that you would recommend that give me maybe a little bit more kind of ability to sleep at night?
So tech as a broader sector, I think to call it the whole thing safe is a bit risky because obviously, as we saw yesterday with some of the software names, not all tech is the same. So I think some of the bigger cap tech, which is less exposed to some of the AI disruption, is a reasonable place because that's a structural theme that's not really going to go away. The other side of what I would call the part of the market that we like is let's go to look at maybe some of the more defensive parts of the market as a bit of a hedge. And that's areas that actually we're working very, very well, especially in January, February, the consumer staples, some of those more defensive stocks which will do well if there is some sort of a rotation out of cyclicals into more defensive names. I think that's another place in the market where you could see some...
You think Electrolux would be a consumer staple, wouldn't you?
Well, I mean, yes. I guess if it's tied to house moving, I don't know.
Anything like that?
A bit more complicated, maybe. But, Obi, what about volatility? What about volatility? I mean, we've seen a bit of a collapse in volatility since it shot higher in March and then came right down. We seem to be creeping higher on oil rather than jumping higher in a sort of stunning fashion. Does that mean volatility stays contained?
It's hard to know. Any event that could play out in the next 2 to 3 weeks could see us see volatility move a bit higher. I mean, what concerns me more as a fund manager is I'm concerned about volatility that's driven by a change in fundamentals. So if companies start to report that the oil price is affecting earnings and profits and therefore they're having to downgrade numbers, then that's a much bigger concern than the volatility that's driven just by the market itself and uncertainty and fear. And I think that's most of what we've seen this year. It's been more of a fear of something going wrong rather than actually the reality. And that was what worried me more.
Obe, thanks very much indeed for coming in. We really appreciate it. Obe Ejikeme, Global Equities Fund Manager, joining us from Carmagnac. Let's take a look at the core six. This is what we are seeing first thing this morning. Tech is front and centre. SAP certainly rallying, got hit hard yesterday. Some of the luxury names are under a little bit of pressure. There's some big moves out there this morning, maybe not represented here. Defence under a little bit of pressure. Maybe that's the only standout story from what you see here. But SAP is on the move. Electrolux is on the move. There are some single stock stories today that are definitely worth paying attention to. Chloe Melly.
Good morning, Guy. You asked for a two-day chart for SAP. Here is a two-day chart for SAP. As you can see, we've gone into the results with quite a lot of pessimism, in part because the US peer of SAP ServiceNow had quite disappointing results yesterday, and that raised questions and fears around the software sector in general. But then we have this rebound today because SAP had those really reassuring figures, which eased those fears around both AI disruption and also the impact of the Iran war on business confidence and on those software companies' ability to close those deals. And so we are seeing SAP move much higher this morning. Moving on to Siemens Energy, which is also seeing some upward movement this morning. It is up. It was up a little bit more strongly at the open. It's up now 0.1% after raising its outlook because of its exposure to both AI and electrification. So it's one of the big beneficiaries of this growing infrastructure demand from data center customers and power grid customers. And so we are seeing a bit of movement there. Adyen, the payments firm, is also in the green this morning after making its first acquisition. It is buying Talon One, which is a platform for loyalty and incentives. It's the first acquisition. It's one that is received quite well, with shares up about 4% this morning. And finally, let's end with Electrolux, the home appliances company, which is most definitely in the red this morning. A massive drop of more than 23%. After reporting much weaker than expected first quarter figures. That was due in particular to a lot of weakness in the North American market, which is a really key one for Electrolux. So we're seeing a massive drop this morning.
Thank you very much, Chloe. Chloe Melly with the stocks on the move then this morning. We are monitoring what's happening over in Nicosia in Cyprus. EU leaders have all arrived now, it would seem, and they're gathering for this EU leaders summit. Emmanuel Macron has been the last of the leaders to be, one of the last ones to go in, and we heard from him saying that he and Merz have tasked their defence ministers to work together. So that's certainly one thing they'll be talking about, no doubt, is defence, Ukraine, money for Ukraine, Ukraine membership, all of that very much in focus, and energy policy as well.
We also heard, of course, from the Spanish Prime Minister Sanchez talking about the need for more in terms of trying to address the energy constraints. Oliver Crook is on the ground for us in Nicosia, so we'll get an update as well in the next few minutes. Coming up, though, SAP getting a lift from AI. As cloud growth beats expectations, the stock up today 5.8%, beating expectations on the earnings. Highlights from our conversation with the CFO coming up next. This is Bloomberg.
It has been a very solid start into the year, enabling us to confirm the outlook we have provided for 2026. We increased on constant currency terms cloud revenues by 27%. We increased our non-IFRS operating profit by 24%. If you then compare that to the ranges we've guided for the outlook, you see that this is actually above these ranges, giving us, so to speak, a head start, despite what I would consider a quite adverse environment, given what we've seen in the Gulf region.
SAP's CFO, Dominik Asam, speaking to us earlier. SAP shares are higher after reporting stronger than expected revenue growth in its cloud division. The stock is up 6% right now, beating analyst estimates in terms of the earnings. On a 12-month basis, the stock is still down about 37%, so that's the context. But today, up a decent session for SAP on intraday basis, up 6%. Joining us now is Matt Bloxham, Senior Analyst at Bloomberg Intelligence. Matt, what did you make of these SAP results? Are you reassured that they are no longer a victim of SaaS apocalypse, that they can rewrite the boat, that they can reassure investors that they have a plan?
I mean, they definitely have a plan. I think this is like an encouraging update, but I think there's still a long way to go. I think for companies that have got SAP in their technology stack and have had it for years, it would be a big leap to take to a kind of a new AI startup. So they have a big opportunity to kind of retain that business, but they really do have to convince them that their AI technology upgrade works. And there's a big question about the pricing model. There's a big potential shift away from a subscription model to a usage model. That's a huge amount of exposure for corporates in terms of how people are using this. So I think that could be a little bit of a kind of a glitch in the system, or something they still need to resolve.
Is Intel in the kind of same boat, i.e., the numbers look reassuring, better, they were good numbers, but if you take a step back, you realise that this is a business that's still got an awfully long way to go?
It definitely has a long way to go. I think maybe an interesting difference for me is that the legacy of Intel kind of CPUs and having historically close to 100% share in that business is coming back into fashion. We're kind of through the huge focus on training AI models now into inference, usage, and as corporates use it more, they're turning back to general processing, the CPU compute that Intel's always provided as the kind of foundational level of that. So
are they a leader in that space, or is it?
Yeah, so the Xenon product offering is what's kind of really driving this growth again. So there's a big opportunity for them there, and it's kind of coming back. I think the other thing that's still kind of work in progress is the foundry business. So this is their idea of essentially becoming kind of like a US version of TSMC, and I think they're still kind of largely reliant on their own business to drive that, but the fact that their CPU business is growing helps that. And we've had signals from, for example, Elon Musk, who also wants to build his own chips, that he's going to use Intel's foundry business for that. So early stage for that bit, but some encouraging signs there.
That is interesting. Help us understand the job loss story then, Matt, because we've seen from Meta and we've also seen from Microsoft some substantial announcements around jobs cuts. Something of it's easy to conclude, is this a sort of AI-related jobs apocalypse? But then there are going to be plenty of other AI growth stories that are creating jobs, and even these businesses are probably recruiting on some AI roles. So give us the context that matters.
Yeah, so 23,000 jobs across these two businesses, 14,000 of them at Meta and 9,000 or so at Microsoft. For Meta, it's about 10,000 roles that they're getting rid of, and another 6,000, so maybe kind of 8% or so, where they're just not going to fill vacancies. So it's quite significant. My sense is that at least some of this is them readjusting the business after overhiring kind of through the kind of pandemic period, where we saw a lot of these big tech companies kind of really, exactly. Obviously, they are spending huge amounts of money on AI, and they need to balance the books to some degree and show their investors that they're being responsible with their costs. I mean, I did some rough numbers that maybe this is like a couple of $1 billion maybe of operating costs for them out of a total cost stack of $120 billion. So it's relatively small, but I guess everything helps when you're trying to kind of show that you're managing your margin when you're making these big investments.
Meta and Microsoft both obviously investing heavily in terms of the hardware. Is Deepseek going to be another reminder that maybe the costs that are being sunk into AI infrastructure don't need to be there? They're coming out with a new model. They've come out with a new model. They say it's the most powerful open source model that's currently available. Yeah, so this is the kind of the V4 model, and certainly seems to be pitching as comparable on performance, but way better in terms of efficiency. And obviously, as more corporates start to use AI, they're going to be really focused on how much it costs to run these things. Now, I mean, there clearly is a bit of a kind of China, non-China divide here. So I think, you're not going to see a huge number of US or developed Europe companies move over to Deepseek, but for the rest of the world, this kind of is a kind of serious proposition for them. So it's an interesting development. It definitely kind of shows there's a lot of competitive tension in the market, and there's lots of different ways to kind of evolve this. And I think there's a lot for the likes of OpenAI and Anthropic and Google to learn from the approaches that Deepseek is taking to reduce their own costs. Because ultimately, all these kind of big developed market AI companies are going to come under pressure from their customers about how much it costs to run AI.
Matt, thank you so much. A really good rundown of all the tech news overnight and this morning. Matt Bloxham from Bloomberg Intelligence. Let's move on to the oil price story. Oil prices in flux, but moving higher broadly this morning as uncertainty over talks between the US and Iran threaten to further delay flows from the Persian Gulf. That's as both sides maintain their blockades of the Strait of Hormuz. President Trump has ordered the US Navy to shoot any boat putting mines in the Strait. For more, we're joined by Waylin Sun, who is our oil and shipping reporter and somebody who tracks very carefully what is and and is not getting out of the Strait of Hormuz. Waylon, good to speak to you. Thank you so much for joining us. Bring us up to date on what is getting out right now. We have these 2 blockades in place. We see reports sometimes suggesting that maybe some Iranian ships are getting out, but the US administration saying no, that's not the case. What are the facts that we can verify?
So traffic through the Strait, traffic through the Strait seems pretty empty right now, and these are ships that are turning on their transponder signals. We don't know for sure how many ships are going through dark, but safe to say these are Iran-linked ships. This morning at Singapore time, we saw a VLCC, which is a super tanker, laden with Iranian crude, attempting to transit the Strait of Hormuz. So we don't see any merchant vessels going in or out, signaling clearly that they're going through the Strait. So it's safe to say what we are seeing now is reverting the status of the Strait of Hormuz back to what we saw in the initial phases of the war.
So we don't know when it's going to open, and even when it does open, we don't know how long it's going to take to reopen fully. You saw that conversation, obviously, last Friday, taking place. So what are you hearing about how this process could unfold? Even when it does open, how long will it take to get back to normal?
It's anybody's guess because the calculation for the reopening of the Strait becomes quite different with each passing day. And if we look at how oil production has been shut in, the longer each day that the Strait doesn't reopen, the harder it is for oil production wells to resume production because of the way the soil and how the refineries work. They need to be in constant utilization for them to work properly. So today there is a Goldman Sachs note that comes out to say that oil production is still about 14.5 million barrels per day less than before the war started. And with each day that the Strait remains closed, the longer this resumption of oil exports would be when it reopens. So if you think about it, if the Strait reopened right when the war started, it would be sort of like a V-shaped recovery. But now, the longer it drags on, it becomes more of a U-shape, a very, very shallow U-shape for oil exports to resume through the Strait.
Again, we get this different kind of narrative emerging. Equity markets looking for that V-shape still. Maybe other markets looking at a fairly different picture. Waylon Soon, thank you very much indeed for the update. That's the problem is, though, at the moment, we don't know how long the energy crisis will last for. We don't know when it's going to reopen, and when it does reopen, we don't know how long it's going to the effect is going to last.
Are there 3 different scenarios you could look at when it comes to the Strait of Hormuz? 1, a continuation of what we're seeing right now, which is a standoff. Number 2, a very thin, slim deal that the two sides come to. You don't get a comprehensive deal. Number 3, you actually return to military action. You actually turn to full-on conflict. And we're quite close to that. We're shooting at vessels at this point. Trump doesn't want to go there. But that is the risk.
And we have no meeting in the diary. We do have a meeting, though, of EU leaders. We'll get some analysis of that. That's coming up shortly. This is Bloomberg.
This is the opening trade. We are 30 minutes into the Friday session. European markets turning cautious. There's been some earnings strength coming through from the likes of SAP, and that is helping the DAX, which is up 0.1%. But across the benchmark in Europe, you're seeing losses of 0.5%. You're continuing to see that divergence, particularly when you look at the US future story versus what you're seeing in the European equity space. And that has been something of a trend this week. On the upside, you've got the likes of tech and energy. That is helping to some extent. But again, across the benchmark, down 0.5%. Again, it's coming through for the DAX, down 0.6 on the CAC current over in France, and losing 43 points so far on the FTSE 100. Guy.
Yeah, Siemens Energy and SAP certainly stand out stories. We'll come to the leaders in just a moment. This is what the internals look like. 420 down, 158 up. So definitely a bias on the downside in terms of what we're seeing in terms of the breadth this morning. Volume again. This is the story. Our pension funds are kind of sitting on their hands. Are institutions selling? Are they not selling? Feels like the fast money has definitely been a driver of the story, which makes this kind of a very narrow narrative that we see around equity markets at the moment. And Europe speaks to that on a daily basis in terms of the volume picture that we are seeing. Leaders, SAP, I urge you to take a look at the 2-day chart just to give you a sense of context as to the rally that we are seeing this morning and the offsetting factor of what we saw yesterday. So we're kind of back where we started at the beginning of Thursday's session. Total is up quite nicely. Volvo Trucks is up quite nicely as well, painting a positive picture about demand there, particularly over in the United States. You listen to the kind of the trade on the trucking sector at the moment, and they're painting quite a positive picture over in the States as well. Let's talk about what's happening on the downside. You are seeing some weakness in some of the pharma stocks this morning, pretty much across the piece. Astra is one of those. It's down by 2.4%. Electrolux is the real standout story. Rolls is down this morning, but Electrolux, I think, is the real standout story. A real downside move, just reflecting this consumer caution that we are seeing, and you're seeing stock after stock, particularly in this space, under significant pressure. Electrolux is just the latest version of that. High costs on the input story, but weak demand on the output story. That is the narrative that some of these stocks are having to deal with right now, Anna.
Yeah, absolutely. They cited the US, didn't they? But we also saw weaker consumer confidence out the UK as well. Let's get to some other stories that we're looking at this morning. TSMC shares climbed to a record after Taiwan's financial regulator eased limits on single stock fund holdings. The Financial Supervisory Commission is planning to relax a rule capping money managers from putting more than 10% of a fund's net asset value into any stock, allowing up to 25% in certain cases. JP Morgan says the move could draw more than $6 billion of inflows. Japan's key inflation gauge accelerated for the first time in 5 months, suggesting price pressures were building even before the full impact of elevated oil prices ripples through the economy. The Bank of Japan will release its next rate decision on Tuesday. Politics in Japan also very much in focus. And the European Union is warning member states that efforts to strengthen safeguards in the bloc's trade agreement with the United States may cause the deal to unravel. The EU's trade chief, Maros Sefcovic, will discuss the deal with US Trade Representative Jameson Greer and Treasury Secretary Scott Bessent in Washington. That conversation taking place later today. Tom.
Meanwhile, sticking with the EU, Bloomberg learning that leaders have signalled prelim conditions are now in place for Ukraine to begin the first stage of the membership process. This comes after the bloc gave final approval to a €90 billion loan package for Kyiv. Of course, that took some time to get across the line, but they've done that now, a big achievement for Europe. Bloomberg's chief Europe correspondent Oliver Crook joins us now from Nicosia, Cyprus, where leaders are gathering for that summit. Let's start on the question of Ukraine, Ollie. How real is this accession for Ukraine to the EU? Is that process now gaining momentum?
It absolutely is, Tom. And listen, we should say that this has been a really spectacular couple of weeks for Volodymyr Zelensky, the president of Ukraine. First, with the defeat of Viktor Orban in the Hungarian election, and a lot of things that flow from that. We should say that Orban himself did, in the end, approve that €90 billion loan that he initially agreed to back in December. There were real doubts about whether or not this money would get to Ukraine, and in a timely fashion. It's really seen as the lifeline, really the sort of survival money for Ukraine for the next 2 years, and that now seems to be squared away. So a huge amount of relief for the Ukrainians. They also passed the 20th sanction package from the European Union. They're now beginning work on the 21st sanction package, again, without the sort of difficulties of the Hungarians. But as you point out, Tom, this is the next big step for the Ukrainians, if and when they will join the European Union. It's something I spoke to the Prime Minister of Estonia last night in a discussion about what their position is and what the timeline they see. Have a listen.
Yes, we probably will be talking about this today and next meeting and so on. Our position is that we support Ukraine in the European Union because, to be honest, there's no other way. Ukraine belongs to Europe and Europe is stronger with Ukraine.
So absolutely fundamental for the Ukrainians. And what the Ukrainians are now trying to do is get a definite timeline for when they could potentially join the European Union. I spoke to the man who was in charge of negotiating that from the Ukrainian side a little bit earlier this week in Brussels. They say they're going to be ready by next year. I think by anybody's timeline, that is a very aggressive timeline. So that's what we're going to try to get from some European leaders. How long do you think it will take for the Ukrainians to get into a position to start really accelerating the conversation about them joining the European Union? The Lithuanians, for example, said yesterday could be by 2030. So we'll speak to a number of leaders here about that.
So that's certainly an important conversation taking place there in Cyprus. Ollie, also under discussion then, how Europe responds to the energy situation that we're seeing coming through, but being passed on to Europe from the Gulf, of course. What measures are really under discussion there? We've heard talk earlier this week about jet fuel, about energy taxes. Pedro Sanchez talking about how he wants fiscal rule flexibility for energy. What's really in focus for the European leaders meeting?
Yeah, I think Pedro Sanchez's comments just a few minutes ago helped sort of focus the attention. We heard from Giorgia Meloni, the Prime Minister of Italy, last night, saying that basically the EU measures that had been proposed so far were a good start, but really don't go far enough. And that's a message that Pedro Sanchez echoed this morning. So what he is calling for is talking potentially about loosening fiscal rules. This is obviously something that's very important, particularly post-COVID, post that energy crisis. There's not a lot of fiscal space in a lot of these different sort of nations. Also a conversation potentially about windfall taxes across the European Union to energy companies to help finance some of these things. So these are two sort of concepts that have been spoken about in the background, but now are coming to the foreground in a sort of very public discussion. So a lot of sort of news coming from the Spanish. We should say another sort of interesting storyline that we're watching here on the sidelines of this meeting is this story out from Reuters just a couple of hours ago saying that the United States is looking at possible reprisals for NATO members that did not help them out with their initiative in the war in Iran and the Strait of Hormuz, apparently looking at potentially contesting or changing the U.S. position in recognizing the Falkland Islands as part of the United Kingdom, but also critically, if this is in fact true, an email circulating around the Pentagon saying that they're potentially considering kicking Spain out of NATO, the only nation that is not willing to reach that 5% spending target. So a lot to discuss here, a lot of concerns, of course, about NATO and collective European defense and other sort of articles that might need to be enlisted in the absence of a sort of full U.S. commitment to NATO, which Trump has been calling for the last couple of weeks a paper tiger.
You do kind of wonder what happens to the Rosen Naval Base at that point, but we'll park that thought for the time being. Ollie, thank you very much indeed. Oliver Crook reporting from Nicosia and the EU leaders meeting that is taking place there. Oliver will be speaking, Anna, to various presidents later on throughout the morning.
Yeah, absolutely. The presidents of Lithuania and Romania later today. He was just setting up some of that conversation for us, talking about the Ukraine accession conversation. So that's certainly going to be in focus. That all on the sidelines of that EU meeting, Guy.
OK, let's dig deeper into the energy pressure facing Europe in the wake of the Iran war. Let's bring in Maria de Mertzis, Professor of Economic Policy at the European University Institute. Maria, what can Europe do this time to shield its economy, its consumers, from the ongoing energy crisis? And are we in any way in the same situation that we were at the end of COVID?
We're not in the same situation. We are in a similar situation, but I think it is much lighter now than what it was in the energy crisis in 2022, and indeed in the pandemic. What you see countries are doing right now is indeed having measures that are extremely targeted. That means that it is really focusing on helping those that have had a disproportionate weight of the current energy bill. And this is very much also the advice that the Commission is saying, given that, of course, that fiscal space is much more reduced now than what it was 3 years ago and 5 years ago. Also, the European Commission is urging countries to be absolutely ready to come out of it, of these measures, as soon as we come back to some normality, whatever normality might mean these days. So I think what we've learned from the two previous crises is really to focus, identify the weakest as much as possible, quickly as possible, and really help those, but also be very, very quick in reversing those measures. I think the one thing that we need to see is whether the European Commission will tolerate some more flexibility on its own fiscal rules. We have done it before. However, every time we break the rules because we have to, the credibility of these rules is eroded. So, we need to wait and see whether the Commission will actually pursue that.
Do you think demand destruction measures are going to be on a nation-by-nation basis? It kind of feels like the Commission is willing to take easy measures, is maybe the wrong way of putting it, to talk about those, changing taxation around electricity prices, etc. But when it comes to actual demand destruction measures, i.e. don't travel, don't do this, it comes down to national capitals to make those difficult decisions.
Absolutely. It always does. And also there is no need to coordinate at that level right now because the shock is manageable, I think. So it is always the countries that will take those measures and will bear also the political cost or gain of these measures. Absolutely.
Maria, if I was a CEO of a big energy company in Europe, should I be worried about windfall taxes? Does that gain traction, do you think?
Oh, yes, we have used this measure before. And to be fair, I think that corporates have been quite understanding of these measures back in 2022 because they were really very, very big and they were windfall. They were not structural. So I think there is some understanding on the corporates with differentiation, of course, depending on how much you're hit by the shock. On understanding that this is exceptional and everybody has a role to play in this crisis. So I think the experiments have shown us in 22 and 23 that corporates were very cooperative when it came down to this.
I just want to be clear in terms of the energy shock facing Europe right now. If this is prolonged, the standoff that we're seeing in the Straits of Hormuz, do we end up with shortages of oil and gas in Europe or just higher prices?
No, I think it's both. And we will see first the prices moving and then the shortages. There is actually a discussion about what would mean for the quantities on the energy right now in the EU, simply because we have depleted the backups that we had on energy, all the stockpiles that we have. We are actually depleting those. So we are in an urgent need to restock, to pile up again. We will see this, but it all depends on the prolongation of the shock. So it's very difficult to forecast this, but it certainly is in the policy minds, in the minds of the policymakers.
Maria, away from the direct economic impact of what we're seeing in the Middle East, I know that there's been a lot of tension amongst typical allies, certainly around NATO and amongst NATO members, and we're seeing that most recently just this morning. How are the European leaders who are gathered there thinking about those tensions and what Europe needs to do in the face of them?
It's very interesting because the Cypriot presidency has actually put on the agenda the discussion around Article 42.7. This article is an article of the EU treaties, and it is the equivalent of the Article 5 of NATO, which actually talks what happens in the occasion of military attack, and the assistance that countries, members, allies will provide. We do not have a scenario planning of actually invoking Article 42.7, and Cyprus, I remind you, is not a member of NATO, and therefore they're very eager to understand what would happen if we were ever to invoke this article. The reality is that the NATO procedures are the only procedures we have which are ready enough to answer that question effectively. So on the European side, we do not have an idea of what invoking Article 42.7 would actually look like in terms of preparedness. So I think it's very urgent that the European countries think about what this would mean, because, as we've heard, it's not obvious that the US would actually help in the occasion of an attack.
And within or outside NATO, I suppose more spending on defence is the thing that's important, Maria. How convinced are you by the plans that European governments have talked about for increasing defence spending? Clearly, Germany's the big one that stands out right now and such a big pivot, but they have the fiscal space. Elsewhere, are you convinced by a willingness to spend on defence?
Oh, absolutely. And you see it already in the public debate as well, because given the very short fiscal space that exists, there need to be cuts elsewhere. You need to take it from elsewhere and give it to defence. But I think that battle has been won. It happened last year. And all countries are very convinced about the need to spend more defence and are actually doing that. Now, the speed at which they do it, of course, varies between countries. Germany is the one that accelerated the most. It was also the country in need of acceleration, but everybody else is doing the same thing, and we will reach the 5% within the 5 or 6 next years.
Maria, thank you very much. Maria de Mertzis, Professor of Economic Policy at the European University Institute. Thank you very much for joining us. Coming up, we will talk about some of the themes around energy and how it's affecting the aviation sector. Airlines scramble as a fuel price shock hits the industry's profits. We'll bring you the details next. This is Bloomberg.
Welcome back. 48 minutes past the hour. Let's talk about what is happening in the airline sector. Increasingly on the front line when it comes to the fuel shortage story. Global airlines certainly scrambling to manage jet fuel costs on the back of what we are seeing in the Gulf. American has cut its full-year outlook. Southwest declining to update its full-year profit guidance. Similar story over here in Europe. Let's bring in Bloomberg's managing editor for aviation, Benedict Campbell. He joins us now from Berlin. Benedict, this is the week that it felt like the airline sector started to put size and scope on the challenge that it now potentially can face, would face, maybe will face. We don't know yet. What do we know at the end of this week that we didn't know at the beginning of the week?
Well, we certainly know more of the cost picture that is facing the industry. We heard from American, they said that they expect $4 billion in additional fuel costs for this year. As you said, we've had a number of airlines reporting this week out of the US, principally starting with Alaska, United, Southwest, American, as I said. And the picture there is fairly universally bleak. In terms of the outlook, they all say that we don't really know what the rest of the year will look like. As a result, they've either suspended or cut their forecasts. The only good side of this really is that the demand picture seems to be holding up. So the customer is still booking, the customer is still booking expensive tickets. And as a result, the airlines are able to sort of hand off and pass through some of these costs, or actually quite a lot of these costs, to the customer. The question really is, as this continues into the summer and beyond, will the customer still be able or willing to stomach these additional costs? And that could quickly change if at some point customers start saying, I'm not going to take this long haul trip, I'm going to drive somewhere instead. Then very quickly the airlines will have a very different problem on their hands.
Yeah, that's really interesting, certainly in the face of some of the consumer confidence data that we've been looking at. It's interesting that it's holding up then, Benny. What about the self-help measures that airlines are taking here? I know we've got this example of Lufthansa adopting a sort of budget model when it comes to some of its fare structure. Are we seeing surcharges spelt out on bookings yet for fuel costs? I remember periods where we've seen that, and that was quite normal for a time.
Yes, all of the above, really. So we've seen these fuel charges, these surcharges happening for a number of weeks now. Really, a couple of days after the war in Iran, late February, that's been going on, and that's been going on across the world. We've also seen airlines take out capacity quite robustly, so they are scrapping flights that they didn't feel were profitable, even when fuel was low, and certainly are unprofitable now. We heard from Lufthansa, they are scrapping a whole subsidiary, their city short-haul operation, because that was also on the cusp of being unprofitable, and they took this step now. Really, airlines looking left and right where they can cut costs and where they can sort of rein in their spending. Some airlines have suspended or grounded some of their more fuel-guzzling aircraft, like the old Airbus A340. So a lot of those things are happening, but they're sort of all on the margins for the time being. Obviously, the big one that everyone is sort of waiting for, the big bang, shall we say, is consolidation happening in the industry. And again, that's where all eyes are on the US. A lot of noises, speaking of what we learnt this week, a lot of noise coming out of the US industry that consolidation might well happen there as a result of these additional costs.
Yeah, Spirit Airlines seems to be front and centre, and certainly part of the thinking of President Trump and his team for now. Bloomberg's managing editor for aviation, Benedict Carmel, on the update in terms of the impacts on the global aviation sector as a result of the energy crisis that we are witnessing. Thank you. We're wrapping up, of course, a big week of corporate earnings as well. Here to walk us through what we've seen so far, Rod Turnbull from Bloomberg Intelligence. Rod, I'm looking at the S&P 500 and the earnings story there, which is that about 80% of companies on the S&P 500 that have reported earnings have beaten. Maybe it's not such a bright picture in Europe. Walk us, what has stood out to you in terms of the European earnings season? Maybe you can fold in some US names as well. Is there a clear takeaway at this point, at the end of this week?
No, sure. I think there is. If we take a step back, 2.5 weeks ago, we sat here and we looked at markets, major indices at support levels or breaching support levels. You wind that forward and, we're at all-time highs. And the question becomes why? Despite the fact oil's 106 and we've still got no resolution in the Middle East on site, right? And maybe part of that response is cash. So our strategists look at $1.35 trillion worth of cash sat on companies' balance sheets in the U.S., in the S&P 500, generating about $475 billion of cash flow. That's a huge amount, and that'll act as a buffer. The European results season, we'll see some benefits of that, obviously. And actually, it's been okay. If we look at it overall, currency's been an impact. So we've got sales flat. Add currency back and you get maybe 3-4% growth in sales, and earnings is growing 3% so far. Again, add currency back, you get maybe 5-6% growth. So it's not too bad so far.
What do the forward-looking indicators look like, though? What are the companies telling us about what happens next?
Well, interesting. You had Matt Bloxham on here talking technology just a little while ago, and you can see the benefits that AI is having and that huge cash pile that's flowing through an awful lot of the companies, right?
Outside of tech?
Outside of tech, industrials, which is that beneficiary of technology as well, right? So we've got ABB, who had triple-digit order book in data centers, looking like it's taking market share. And, of course, what we'll have next week is Schneider Electric report, which will, again, give us that little bit of an insight, and they're probably coming off a higher base than ABB is as far as their DC exposure is concerned. But that'll give us another piece of the puzzle in terms of how that AI capex is flowing through European companies.
Everybody wants to sell things that go into data centres, whatever they are. Consumers, how are consumers holding up? Because, I mean, overnight we got some UK consumer data that looked a bit gloomy, but from the earnings picture, what does that tell us?
I guess we always get hit with inflation a little bit harder in the UK than elsewhere. But, actually, again, if you look at Nestle, Danone, L'Oreal, they beat in many instances, so that staple side of the equation looks okay. And even in luxury goods, you take out the Middle East exposure. LVMH is a good example. They had 1% organic growth. It would have been 2% organic growth, which would have been in line with what the market was looking for. So again, it's not terribly bad for all that's being thrown at them. And the one addendum to that as well is if you think about the U.S. consumer, how top-heavy it is in terms of the earners who consume in the U.S., got a big IPO pipeline coming. There's probably an awful lot of wealth generated, and you do wonder if luxury will see more North American support, having got over its China hangover.
What are you most excited about for the earnings next week, Rod?
I think, again, it's those little indicators. Atlas Copco.
Yeah.
So we can get another look into the semi-supply chain. We heard VAT Group say that, there's a shortage of helium and bromine. So there are constraints in that supply chain despite all this capital. And we have to remember, there's a lot of capital chasing all the same stuff. So there's going to be constraints. And I think in that, the message is inflationary pressure. And are we taking our eye off the ball a little bit? Maybe it's not tomorrow, but over the course of this year with markets at highs, supply chains start to creak and that inflation starts to come through. And then we've got Microsoft and Meta. And as I say, Schneider will give us that European feel on DC spend.
Great stuff, Rod. Thank you very much indeed. Nice
Pleasure.
to see you.
Thank you.
Rod Turnbull joining us from Bloomberg Intelligence. That's all next week. The weekend is almost upon us. London Marathon this weekend?
Not personally, no.
No?
You, Tom?
I've run a marathon, a single marathon.
Excellent. That's it. You've ticked that
This
box
week
then.
has felt like a
I've done
marathon to
that.
me.
Yes.
But it's beautiful weather for London Marathon. Perfect.
Yeah.
Well, I don't know. Good for watching. Is it too hot for running? I'm not sure.
Tom is barbecuing. I think we just we'll wait for the smoke signals from North London.
I'm interested to see that we've got the Netherlands King's Night, Koningsnacht, ahead of Koningsdag on Sunday night. So if you need a party on Sunday night ahead of what will be an extremely busy week next week.
Is that a big party in the Netherlands?
It's a very big party. Amsterdam, Utrecht, Rotterdam.
That sounds. The Saints are in action this weekend, both in terms of Southampton Football Club and Northampton Saints against Bath. Semi-finals, the FA Cup.
Yeah, we need Arsenal to beat Newcastle, 5:30 tomorrow.
Yeah, Arsenal. Do you want to talk about Arsenal?
Not really. Have a great weekend, everyone.
Yes, we've got some great newsletters out over the weekend. Enjoy them. This is Bloomberg.